What if I told you that the US government is considering a tax on foreign investments? Not just a tariff on goods, but a tax on money itself. It sounds extreme, but it's a real policy idea that's gaining attention, and it could have huge implications for financial markets. The goal? Rebalance the economy by reducing America's dependence on financial speculation and boosting actual industries like manufacturing. But could such a tax backfire? And is there a better way to achieve the same results? In this video we'll explore what this tax proposal actually involves, why the US economy became so financialized in the first place, a smarter alternative, tokenization of US assets, how all of this could impact global markets and investors like you. This isn't just theory, it's a potential shift in how money moves around the world. Stick around until the end because the details might surprise you. My name is Nick, and you're watching InvestingHub. Let's get into it. The idea of taxing foreign investments in the US isn't new. In fact, it was first seriously considered in 2019 when Senators Tammy Baldwin and Josh Hawley introduced the Competitive Dollar for Jobs and Prosperity Act. The goal was simple: reduce capital inflows until they match outflows, effectively eliminating the US trade deficit. This bill proposed a gradual tax that would increase over time, forcing the economy to rebalance itself. The reasoning behind this tax is that America's economy has become too dependent on financialization, where wealth is generated through markets rather than industrial production. By making it more expensive for foreign investors to pour money into US assets, the government hopes to shift the focus back to real economic growth, like manufacturing, infrastructure, and technology development. This proposal resurfaced recently thanks to American Compass, a think tank with ties to the Trump administration. They argue that foreign investments have hollowed out the U.S. economy, reducing industrial output by 10% and manufacturing jobs by 35% since 2000. A small tax on these investments, they claim, could generate $2 trillion over the next decade. On the surface, this tax seems like a clever way to redirect capital into productive areas of the economy. But there's one big risk: foreign investors may not play along. If major global investors decide to dump U.S. assets in response to this tax, it could trigger a financial crisis before any of the intended benefits materialize. The U.S. stock market is the largest in the world, accounting for over 40% of global equity markets. Investors park their money in U.S. assets not just for returns, but because of security, liquidity, and strong property rights. If this tax were implemented, the question remains: would these investors absorb the cost, or would they seek alternatives in other global markets? For now, this tax is just an idea being discussed in policy circles. However, given the increasing trade tensions and Trump's history of unpredictable economic policies, it's worth paying attention to. Could this become reality in the near future? And is there a better solution than taxation? To understand why some economists are pushing for this tax, we need to explore a much deeper issue: why the U.S. economy became so dependent on financial markets in the first place. The answer lies in something called Triffin's dilemma. In the 1960s, economist Robert Triffin identified a paradox. When a country's currency is used as the world's reserve currency, that country must constantly supply more of its currency to meet global demand. The problem? Doing so weakens the domestic economy, as financial speculation becomes more profitable than actual production. The US dollar is the world's primary trade currency, meaning countries worldwide need dollars to conduct business. This demand artificially strengthens the dollar, making U.S. exports more expensive and less competitive. As a result, American manufacturing has suffered, and the economy has shifted towards financial markets where profits are easier to generate. To offset the side effects of a strong dollar, the U.S. government and Federal Reserve have relied on printing more money and keeping interest rates low. But this only fuels asset bubbles, wealth inequality, and economic instability. The 2008 financial crisis and the post-pandemic inflation surge are direct consequences of this system. A tax on foreign investments is one way to rebalance the equation by reducing excessive dollar demand. However, this approach fails to address the root cause, the global dependence on the US dollar itself. Instead of taxing foreign investors, what if there was a way to reduce dollar demand without hurting the economy? This brings us to an alternative solution: tokenization of assets. Instead of restricting capital flows, we could redirect them into a new financial system that works better for both investors and the U.S. economy. The idea of tokenizing U.S. financial assets might sound futuristic, but it's already happening. Tokenization refers to digitizing stocks, bonds, and other assets so they can be traded on blockchain networks. This has several benefits, but the most important one, it reduces unnecessary demand for U.S. dollars. Right now, if a foreign investor wants to buy U.S. stocks, they must first convert their money into dollars, which fuels the strong dollar problem. However, if these assets were tokenized and traded against stablecoins, digital currencies pegged to the U.S. dollar, this would shift demand away from cash dollars and toward U.S. government bonds instead. Here's why this matters. Stablecoins are backed by U.S. Treasury bonds. This means that if investors start using stablecoins to trade tokenized assets, they're actually creating demand for U.S. bonds instead of physical dollars. More demand for bonds equals lower interest rates, which helps keep inflation under control. Big institutions like BlackRock and Bank of America are already preparing for this shift. They're pushing for more tokenized assets and private stablecoins, which could revolutionize global investment flows. If successful, this system could solve the same problem that a tax on foreign investments aims to fix, but without the risks. Instead of punishing investors with new taxes, the U.S. could use financial innovation to maintain its market dominance while improving its domestic economy. But how would this impact global markets? If the U.S. does decide to tax foreign capital, it could lead to short-term volatility in stock markets. The S&P 500, for example, is heavily weighted towards a few massive tech stocks, the so-called Magnificent Seven, which are widely held by global investors. If foreign capital exits, these stocks could take a hit, dragging down the entire index. However, the bigger impact may be on foreign markets. Less capital flowing into U.S. assets means some of it will go elsewhere, potentially creating bubbles in European or Asian stock markets. Countries with weaker financial systems may experience excessive speculation and instability. The good news? If tokenization continues gaining traction, the U.S. might not even need to implement a tax. By shifting trading activity towards digital assets and stablecoins, the U.S. could naturally weaken the dollar's excessive demand without imposing strict policies. The real risk, however, is a U.S. bond market crisis. If the government fails to manage its debt ceiling, investor confidence could plummet, leading to capital flight from U.S. markets. This would be far worse than any tax policy. At this point, the financial world is watching closely. Will the U.S. impose a tax, or will financial innovation reshape global markets? At this point, the U.S. stands at a crossroads. Will it move forward with a tax on foreign investments, or will financial innovation offer a better path? The coming years will be crucial, and the decisions made could reshape the global financial landscape. So, what do you think? Would a tax on foreign capital help or hurt the U.S. economy? Drop your thoughts in the comments. I'd love to hear your take. And if you found this breakdown insightful, don't forget to smash that like button to support the channel. Subscribe for more deep dives into finance and policy. Hit the bell so you never miss an update. Thanks for watching, and I'll see you in the next one.